stock market has had a run of about 3.5 months of going mostly straight up. The question is, here we are today, 3.5 months later from November 1st, where does it go from here? Is it starting to soften and maybe even go down, or is it going to continue to go up? I'm going to cover that and going to give you my view along with the views of some other people. Hi, my name is Ben Reppond. Welcome to my YouTube broadcast. Today is February 13, 2024. I take the blogs of some friends of mine who are investment managers, and it was interesting to me listening to their blogs this last week of what they are saying about the market. So there's three of them. I'm going to quote them and give you what they are saying about the market, and then I'm going to give you my view of the market. The question is, where do we go from here? Yes, we've had a nice run. If you've been invested, fully invested, mostly invested, you have probably done well during this period of time. 2023 was an excellent year, and particularly the last 2 months of 2023 was very good. So I'm going to just play these, or not play them, but quote these managers and what they're saying, just clips out of what they have written. First is from Paul Schatz. The Goldilocks economy that so many predicted for 2024 seems to be a bit hotter right now. In other words, no soft landing and certainly no hard landing. In fact, right now, as of right now, no landing at all. Craig Thompson, while the market may be overbought on a short-term basis, from a longer-term perspective, the market is not overbought and has more room to run as long as market technicals remain positive. And then from my friend Dexter Lyons, growth stocks with accelerating earnings and sales are in favor. The S&P 500 and NASDAQ indexes made all-time highs last week as the uptrend continues. So in other words, the theme from others, and I will add mine to that, is that for now, the market is continuing higher. There may be minor pullbacks here and there, but it just seems on an upward trajectory. And some people compare this to 1999. The thing that is different about now in 1999 is that in 1999, it was fear of missing out, piling on, people just getting into the market no matter what. And a lot of the stocks that they were getting into were the dot-coms, the technology companies that were very early stage, even those like Amazon and Yahoo and so forth today that are more matured companies. Back then, they were basically startup or early stage companies, and there was no earnings in most of them, and there was really nothing behind it. Today, what is driving the market mostly are the Magnificent Seven. These are the large company stocks that conversely actually have very strong earnings and are pushing these very strong companies upward, and that is pulling the market upward. So my view is that the market is going to continue to go up until it doesn't. And when it corrects or has more than just a slight pullback, it starts to go into more of a major correction. That's when, you have to determine for yourself when that is. I have my own methodology, but I'd say for now, it's stay invested. There are two things in the way we approach the market. It's either a time to be invested or a time not to be invested. Of course, this is the time to be invested. But we've had plenty of times, I think of August and September, for example. That was a period of time that a pullback. It was not the best time to be invested. Sometimes these periods may go for a month or 2 or 3 or longer. And where you just basically are taking too much risk to be in the market. When we get invested, that's the one question. The second question is, what do we invest in? I see the market as separated between value stocks and growth stocks. Those are the two kinds of stocks, basically. And value stocks are companies like Ford Motor Company, Boeing, Pfizer, JP Morgan. Those are what I would call old economy stocks. They're value stocks more focused on earnings. The other kinds of stocks are growth companies, and these would be companies like Microsoft, Facebook, Google, Apple, Amazon. Those type companies are new economy stocks, and they're focused on sales a little more than profits. Yes, they want profits, but they mostly want sales and growth. So we look for which of those two are in favor, and then we invest in that one. Now let me show you an example. So for example, right now, this is what the stock market looks like. This is the S&P 500, the 500 largest companies in America represented by the exchange traded fund SPY. And you can see this is an 18-month weekly chart. So every move in the chart equals 1 week. And you can see where it is right now and where it has gone. And I put a black arrow in there so you could see it. It is really extended high, and there are people who would say that's too high and it has to pull back some. Maybe it does. But I suspect if it does, that because of the strong earnings and the growth of so many companies, that is going to continue higher even if there is a pullback. When you take the S&P 500, let's look at this line right here, and you break it into these two parts, the value stocks and the growth stocks, I'm going to show it. Then I put those on a relative strength chart. And so I say, okay, which one is more in favor? I'll put growth as the numerator, value as the denominator. So when it goes up, it will favor growth. When it goes down, it favors value. It's not out of favor. It just means that value is doing better when it goes down than growth. So here's what that looks like. So if you stretch this out over this period of time, this is about 18 months. And so you can see on a relative strength basis, there's times, okay, at the beginning of the chart, the first 4 months of the chart, it went down sharply, and then it went up mostly. And so that first part favored value kinds of stocks, and the next phase represented growth stocks, and then I put a black arrow, and then it favors value again. And that goes for a period of almost 3 months at the end of last year. Then for this year, 2024, look where it has gone. I put a red arrow on that. That's growth. That's how much growth has outperformed value this year. So you can see there are, in an 18-month period, there are 4 periods of time where either growth was in favor or value. Now, one approach to this would be you could just stay invested in the S&P 500. Totally okay, or some kind of mutual fund or ETF. Totally okay. But we have found that we get a higher rate of return with less risk by going with the index, which is more in favor. Okay, so that's my view of the market and where we go from here. I do expect some kind of a pullback, as some of these will say right now. I'm going to play a couple of clips. It's probably due for some kind of pullback, but I don't expect a crash. I do expect it to continue and that we will have a positive 2024. Okay, first I want to play a clip from Jay Hatfield, and he will explain why the Fed will likely cut rates not until June and will probably not need to cut rates before June. Now think about this. If the market is strong, which it is right now, why do you want to cut rates? They usually cut rates because there is weakness in the market or in the economy. Usually they'll say the economy, but it does play to the market as well. And until then, they may not raise rates, but they're not going to lower rates. So I agree with his thinking that we are probably in a period until maybe June. So we've got these upcoming periods, in before June. That we'll see what the Fed does, but it probably could. They could wait until June. So take a listen to Jay Hatfield.
Give me a sense of, we're looking at data coming down, CPI, we've got another batch of earnings this week. What moves the needle for you?
Really CPI, PPI, but more importantly, how those feed into core PCE. In fact, we're projecting, which is not difficult to do, that core PCE will roll down to 2.6 and then 2.3 by the end of March, which sets us up for rate cuts either early May and June. And that's why we have a street high 5,500 target on the S&P.
You also have a rather contrarian view on what's happening in Europe.
Right. So even if you're afraid the Fed will wait, which they can, because we have a very strong economy, the European economy is very weak. They don't have any of the advantages we have. They don't have the energy advantage. They don't have infrastructure spending, a shortage of housing like we do. So Germany's in a recession, they're flat growth. They need to cut. So they will cut in June. That'll pave the way for our Fed to cut.
So kind of a similar theme. Scott Wapner interviews Professor Jeremy Siegel from the Wharton School, and he gives his view, and he says kind of a similar theme, that he doesn't think rate cuts are needed at this point, and maybe later, and that the market is headed higher from here. Now, the thing that's interesting about Professor Siegel is that he started signaling a positive stock market back in the fourth quarter of 2022, which is actually when more of the bull market began. Very, very close to that period. He was saying, nope, get invested. Well, at that time, the sentiment was fairly negative, or very negative. And he was saying, nope, this is the time to get invested. So I would say there were not very many people at that time that were saying that. So I would give credit to Professor Siegel for his foresight and his years of experience. And, no one's perfect and no one's got a crystal ball on this. But I think looking back on it, that he had good insight. So I'll play a clip from Scott Wapner and Professor Jeremy Siegel.
Kev, you could, the people who are more cautious or are still bearish are citing these alleged risks to the market. Not to discount any of them, they may be real risks. How significant each one is the real question. Too concentrated. We just went through, the Tony's list and some of the facts around that. They say the market's too reliant on rate cuts. We're not looking at March anymore. All the Fed speakers of the week, and there were many, are on message that we're going to get rate cuts likely this year, but it's not going to come in March. So we asked the Wharton professor, Jeremy Siegel, from your neck of the woods, around Philly, is the market too reliant on rate cuts? And he's said no. Listen.
At this particular point, I don't see the need for the Fed to lower. I mean, take a look at all the real indicators. They haven't slowed down. Even the advanced indicators have not slowed down. When they begin to slow down, and if inflation's under control, which I do think it is, we're going to have those lowering of rates. But I'm not saying that this bull market at all depends on the rates being lowered in March or really even in May.
Is that factual, Kevin Simpson? Do you agree with the professor?
100%. It has to be, because in December, Scott, we came into the year with 100% of us saying there's going to be a rate cut in the first quarter. There's going to be 7, 8 rate cuts this year. And if we don't see it, the market's going to fall off the cliff. Well, the Fed chair put the March rate cut in the rearview mirror. And now May is potentially a coin flip. But we don't need rate cuts at that aggressive level when we have an economy that's still strong. We have a labor market that's incredibly robust. And it comes down to earnings season. These aren't like last year where they're better than feared. These earnings are good. And if they're not good, the stocks are getting punished. So I think we need to see rate cuts this year. I think we will see rate cuts this year. But I don't think we're reliant or dependent upon seeing them immediately and seeing them at mass. In fact, I think the longer we can hold out, the better, and the more we can stretch it out, the better. It's a precarious position, knowing when to cut and when not to. You don't want to keep them too high for too long, but so far so good, and I think the Fed deserves a lot of credit.
Here's a little bit of a view that is slightly different. So Jay Woods from Freedom Capital, he's on Bloomberg, and he is saying that from here, he thinks that what is most overbought right now is large cap, and I would even say large cap growth, but he doesn't say that, large cap, that is probably what is due for a correction, and that as the market cycles, probably from here, that small cap will begin to do better than it has been, and it has not been doing well in the past several months. So take a listen to Jay Woods.
We're at 5K, but you say you're concerned that this rally might be running out of steam.
Yeah, I mean, let's see how far we've come from. It's getting a little overextended. We're excited it's at 5K. Who's not happy about that? But, you know, given the run we've been on, I'm seeing some divergences, and people talk about the breadth isn't there. But in the S&P 500, we're 10% above the 200-day moving average. When that historically happens, doesn't mean we're going to crash or something bad's going to happen, but we're going to pause. It happened in December. It also happened back in July, and we pulled back. So now that we're a little overextended, it would take a lot to go much higher from here. We're watching the CPI this week. That could be the next catalyst. But the CPI is one thing that has moved the markets. And if we pull back, that's not
not a
bad.
bad thing.
You know, we pull back maybe to 5,000 the way we're going.
Don't forget, I mean, we put on, what, 20% since those lows just before Christmas. You do play, I mean, I think you knew that you were coming in today with her, so you played the violin for her. You talked about small caps. You still say that they're 20% off their all-time high. And again, there's lots of notes coming into our inbox talking about a new higher nominal rate and what that would mean for small caps. And some people are saying, get used to a new paradigm, a new higher nominal rate. What would that do to the Russell? What would that do to the small cap? What would that do to value?
Look what it's done already. I mean, it is 23% off its high, as you mentioned, just 20% off of it. It did not pull back like it has in the past. So I brought a chart of the Russell, the IWM, which mimics it, the ETF there. And it was in a nice neutral chop zone, as I like to call it, for about 18 months. And 4 times it got to the top, and 4 times it failed at the 50-day moving average. I have circles there. This time it got to the rising 50-day moving average.
Blew through.
And it held. No, it held, Manus. And now it's back above 2,000 in the Russell. The ETF is just under at 199. But watch the 205 level in the IWM. I think we're going to take a shot at that. That's the 52-week high. And you're going to see a rotation in this market. And rotation is the lifeblood of a bull market. This is what we want to see. So maybe these large caps that have kind of lifted us on our shoulders again this year, pull back a little bit. We'll see what NVIDIA does next week.
Okay, that's it for today. Thank you for watching. And if you have questions or comments, leave them in the comments section below.